Hey guys, and welcome back to the fourth video, the lecture series. We're going to kind of zip through this one. Reason why is because we're going to look at long-term notes payable, right? And we've already have seen notes payable, how to record them, how to accrue interest, right? This is all accounting one. But there are some new facets that we need to understand when dealing with long-term notes payable. Okay, when we're talking about long-term notes payable, remember this is something that it's a formal piece of paper that we sign to borrow money from a bank or from a lender, right? And keep in mind this is corporate accounting, right? So we're not talking about individually. We're looking at this through the lens of a corporation and what does a corporation have to record and what parameters does a corporation have to work within. Okay, so when we're looking at long-term notes payable, we're going to add something new here. Long-term notes payable can actually be secured by an asset. Okay, an example of that would be a mortgage, right? We sign a long-term notes payable. What is securing that note? And think back to the beginning of this chapter, we talked about unsecured and secured bonds. Well, the same thing really applies for long-term notes payable. Okay, so a lot of the long-term notes payable are going to be mortgage backed, meaning company is going to pledge that mortgage or the title to that specific asset as a security for a loan. Okay, so if any of you have gotten a car loan or your parents have a mortgage, right? What backs that loan? Well, it's the asset, right? So, for example, a couple years ago, me and my wife bought a house, took out a mortgage, obviously. Last name's not Rockefeller, so we had to borrow the money. So, what is backing that mortgage? Well, the house, right? If something happens and me and my wife don't pay our mortgage, guess what? The bank's going to come and take the house, right? Same thing with a car loan, right? If you don't pay your car loan, what happens? Well, it gets repossessed. The bank comes and they take the car, okay? So when we're looking at long-term notes payable, especially something with like a mortgage or like, a secured loan, something like that, there are terms that are required, okay? And these terms state that the borrower, which would be the corporation, has to make installment payments over the term of the loan. Now, those installment payments are consisted of two things. Part of the loan payment is going to go towards the balance of the loan, okay? The second piece of that payment is going to be the interest, okay? And we'll work through an example with this. When a corporation or a company initially records a mortgage note payable, they're going to record it at the face value. Okay, so if we, excuse me, if we look at long-term notes payable, let's kind of walk through a little illustration here, and this will show you. Hopefully, it should be clear after this that the payment has two pieces, right? The interest piece and the piece that goes to pay down that principal balance or that original amount that I'm borrowing, okay? So let's look at Porter Technology, right? Issues a $500,000 8% 20-year mortgage note on December 31st, 2017. Cool, right? We know that we're going to book it at the face amount, so that's going to be the $500,000. We know that it has an 8% stated interest rate, so we have to pay 8% interest on that $500,000. And the term of the note is going to be 20 years. Now, the term provide for semi-annual installment payments of $50,926. Okay, this is the payment that the issuer, well, in this case, it's Porter Technology, they stipulate, okay, no problem. We want $50,926 in payments. Okay, now if you look at this, it's a little goofy. Okay, and I'll show you what I mean as we go through it. So we have interest periods, right? It's supposed to be semi-annual, right? So basically every 2 months, right? Or I'm sorry, every 6 months. So on the date we issue it on December 31st, 2017, the principal balance $500,000, okay? Then the first payment rolls around. The company stipulated we want $50,926 from whoever's borrowing money from Porter Technology, okay? Of that payment, certain amount of it is going to be interest, a certain amount of it is going to go to reduce the principal, bear with me here for a second, principal value, okay? Usually in here they give me a pointer. Oh, that's okay. I can fix it in the end. Okay. So what happens, right? The cash payment that Porter Technology receives is $50,926. Porter Technology needs to break down how much of this is interest, how much of this goes towards the principal balance. Okay. So whenever we have to calculate this in a homework problem or whatever, this is a great slide to use, okay, because it walks you through everything. If you have a problem, this is exactly how you should set it up, okay? Meaning we have our interest periods, right? We have our cash payments here. Notice they don't change. They're the same, okay? Then we have the interest expense. How do we calculate interest expense? Well, it's the balance times the interest rate. In this case, it's 8%, okay? Then we have the reduction of principal, right? What's that mean? Well, we want to take our payment and we want to subtract out the interest portion, and then whatever's left over, that's the amount of money that goes to reduce the principal balance, okay? And then finally, we have the principal balance column, which is nothing more than D, principal balance, minus column C, which is the reduction of principal balance, okay? So we started off, issued it $500,000, no problem. First interest period rolls around. The cash payment is $50,926. We need to break this down, okay? So what we do to figure out how much of that $50,926 is interest, we take the 8% and we multiply it by the balance or by the principal balance, which in this case is $500,000. So we take $500,000 times 8%, we get $40,000. That means that first interest payment we charged, or that first payment or installment payment, $40,000 of that $50,926 was interest, okay? Then we need to figure out how much are we reducing the principal balance, okay? Well, that's easy. We take the payment, $50,926, and subtract the interest portion of that payment, which we just calculated, $40,000. We subtract the difference, we get $10,926. This amount, $10,926, guess what? That is the amount that we reduce the principal balance by. So we come over to D, we see that we originally had $500,000 of a balance. We subtract out the $10,926. We end up now with a principal balance of $489,074. That's the balance owed on this loan, okay? Now, the second interest period comes around. No problem. What's the payment amount? Well, it never changes, $50,926. So, of this second payment, we need to calculate what portion of this payment is interest. Well, that's easy. We got $39,126. How in the world did we get that? Very easily. We took our principal balance at the time of the second interest period. The beginning balance of the principal amount is $489,074. We multiplied that by the 8%. That's how we got the interest portion of the second payment to equal $39,126. Okay? Okay, that's great. Now, we have the second period. We already calculated the interest. From that second period, installment payment, how much of that payment goes towards reducing the principal balance? Well, we subtract the amount of the payment minus this period's portion of interest expense, and we get $11,800. So that means that the principal balance is going to be reduced by $11,800. So before the payment, before this second payment, what was our balance? Well, it was $489,074. We made our second payment, so we need to subtract out the $11,800. After this second payment, we have a principal balance now of $477,274. We do the same thing for the third installment payment that they made, or that this person made, or this company made to us, right? Same thing. Look what happens. What's the payment amount? Never changes. Company already stipulated we want $50,926. Cool. Okay. What's the interest portion on this? We need to calculate that. Well, think about it. This third installment payment came in. Before we apply this third installment payment, what's the principal balance? To figure that out, I have to go to D. Well, it's $477,274. We multiply that by the 8% interest. We see that from this third installment payment, the interest portion of that is $38,182. Okay? From this third installment payment, we have the interest. How much then goes to reducing the principal balance? Well, $12,744. Again, how did I get that? I took the third installment payment, cash payment of $50,926. I subtracted my interest expense of $38,182. I get $12,744. Now, after this, since this is the third installment payment, I need to recalculate what is the principal balance. Well, that's easy. Before this third installment payment, the principal balance was what? $477,274. Minus the reduction in principal from that third payment of $12,744, I have a running balance now, or my principal balance after this third installment payment has been made is $464,530. Okay. Interestingly, look what happens as we keep making payments, right? The interest on the loan decreases. Each payment, we're paying less interest. And each payment, more of that payment is going to pay down the principal balance. So the reduction of principal increases as we make payments. As we make payments, the interest expense goes down. Okay? Excuse me. So in the beginning, I said, oh, there's a mix up here, right? These are semi-annual installment payments, right? Notice the dollar amount, right? This is based on a year, not on 6 months, okay? That's okay, right? It's just an error in the slides. The publisher made an error. No big deal. The process is still the same, right? Since it would be 6 months, we should have, let's go back. We should have made the interest payments 4% each time, okay? Because it's semi-annual installment payments, right? But that's okay. So notice what happens first, right? First, we have to book everything. No problem. Okay, excuse me. So what are we getting? Well, we're getting cash, right? And we're issuing a mortgage payable, okay? So Porter Technology issues the bond, right? Or the mortgage note. Semi-annual installment payments, doesn't include taxes or interest. We need to record the entries for the mortgage payment, okay? So look what happens. We are getting cash, so we have to debit cash. We need to credit mortgage payable. Why are we crediting mortgage payable? Well, because we owe this money, okay? So look what happens as we make a payment, right? What's going out? Cash is outflowing, so we have to credit cash for $50,926, right? we need to debit our interest expense for 40,000, and then we credit mortgage payable for the amount of that payment that goes to reducing the principal balance. So basically, all we're doing is once we create this chart, we're just journaling the chart is really all it is. Okay. When we look at long-term liabilities, how they're reported, this presentation is so important. Okay. So you need to put it on a note card, but you need to understand what we're doing here, right? So as we go through this, please pay attention to the titles. Well, the first title we have is long-term liabilities. Notice it's left aligned. And then we indent each of our long-term liabilities. But look how we report them, okay? Bonds payable. We're going to say what this bonds payable is, right? 10%, when's it due? 2022. What's the bond payable amount? Well, it's $1 million. Then we need to subtract out any discounts on bonds payable, or if we had a premium on bonds payable, we would add that, okay? In this example, we just have discounts on bonds payable, so we have to subtract it. Notice the carrying value of the bond, $920,000, right? Then we list our mortgage payable, 11% due 2028. We're saying that, hey, this mortgage payable is actually secured by a plant asset. No problem. What's the amount? $500,000. Cool. Then we list a lease liability. We get $440,000. Okay. The ratios, I'm just going to skip through these again because towards the end of class or towards the end of the semester, we're going to do a nice project, if you will, I guess. And we're going to do financial analysis. That's all. Thought it'd be easier just to put everything together once at the end and just kind of make a fun project out of it. So I'm going to skip through these. Debt and equity financing, right? We kind of talked about this at the beginning of this chapter, right? What are the advantages of bond financing? Well, stockholders maintain control, right? Their control is not affected. Why? Because the bondholders can't vote, right? Bondholders do not have voting rights. So the current owners or the stockholders, they retain full control of the company. Beautiful. Tax savings is another advantage of bond financing. Why? Because the bond interest that we pay is deductible for tax purposes, obviously. Dividends on stock are not deductible, okay? Again, for tax purposes. It is possible with bond financing that our earnings per share may be higher. Why? Well, think about it. The bond interest expense reduces net income, right? However, earnings per share is higher under bond financing. Why? Because we don't have any additional shares of common stock that we issued, right? We use debt or bonds instead of issuing more stock, okay? Real quick, this is actually pretty important. Leasing liabilities and off-balance sheet financing. For those of you that may remember, hopefully, Enron, they did off-balance sheet financing, and as a result, they basically, they went bankrupt. And a lot of people went to jail. However, what happened was they took their liabilities that they owed and they didn't put them on the balance sheet. That's not good, right? So they basically lied to investors, right? They're not showing the debt that they should have. So we have two types of leases here, okay? Operating lease and capital leases. You need to know the difference between the two, right? They're very easy. It's not that difficult, right? An operating lease says that the lessor, and the lessor is the owner of the property, okay? The lessor has substantially all of the benefits and risks of owning that asset. Let me give you an example, okay? Trying to think of a good one here. Okay. I own pizza ovens, right? That's what I make. That's what I sell, pizza ovens, right? And I'll pick on Preston. Preston wants to open a pizza shop. Okay, cool, no problem. But Preston's like, do I buy an oven from Bruce or do I lease one? Well, if it's an operating, let's say he decides to lease. Okay, no problem. Basically, he's renting is really what leases are. You're actually renting something, okay? Operating leases state that you make payments or rent payments, so to speak, but that asset that Preston's using to make pizzas at the end of the lease, that has to be returned to me. That's an operating lease. Okay, so the idea is in this slide's beautiful that it uses the example of like rent a car, right? Renting a car. The lessee, that's the person who's renting the property, goes to rent a car or whatever it's called, and says, "I want to rent a car." The lessor, which is the person who owns the property, says, "Sure, here's a car. Oh, by the way, this needs to be back by 6 o'clock on Sunday." Okay? So what happens is the lessee rents the property and then returns it to the lessor. A capital lease is totally different, right? A capital lease says that I'm renting something, but at the end of the day, or when the lease is up, guess what? I own this piece of property. Okay, that's the difference, right? The difference is what happens to that ownership at the end of the lease. Do I have to give it back or do I get to keep it? Okay, that's how you tell the difference. Now, there is a difference between the journal entries for operating leases and capital leases. So, if I were you, I'd definitely know the difference between operating lease and capital lease, and I'd also know the journal entries, okay? So if we have an operating lease, all we do is just record a rent expense, right? That's it. We debit rent expense, credit cash for an operating lease. If we have a capital lease, we have a leased equipment account on our books, and we also have a lease liability on our books. So whenever we make a lease payment, we're going to debit leased equipment and we're going to credit, or I'm sorry, this is when we initiate the capital lease. Okay, we're going to debit leased equipment, credit lease liability. Okay, now keep in mind that if a lease has a lost the word. It has an element that says ownership transfers at the end of this lease, then a lease that transfers substantially all of the benefit and risk of the property should be capitalized, right? Meaning we put it on the balance sheet. Now, when we're talking about capital leases, right, we're capitalizing it, right? We're putting it on the balance sheet and show that, hey, we actually have all the risks and the benefits of owning this asset. So in order to determine if a lease is operating or capital, right, it has to meet one of the four criteria, right? Transfer of ownership to the lessee, contains a bargain purchase option, lease terms are equal to or greater than 75% of the leased economic life of the leased property. Okay. The final or the fourth criteria that has to be met is the present value of the minimum lease payments equals or exceeds 90% of the fair value of that lease property. Okay, I'll explain this when we look at the other slide, okay, or when we look at the next slide. But for right now, I want you got to know what are the four criterias. Those are the four criterias, okay? One of them has to be met. If none of these criterias are met, guess what? It is a operating lease, not a capital lease, okay? All right, so let's look at an example. Okay. Gonzala Company decides to lease new equipment. The lease period is for 4 years. The economic life of the leased equipment is 5 years. The present value of the lease equipment is $190,000, which equals the fair market value of the equipment. There's no transfer of ownership during the lease. There's no bargain purchase option. What type of lease is this? Well, let's go through each of our questions, right? Or each of our criteria. Okay. So what type of lease is this? Well, first question says, does ownership transfer? At the end of the lease terms, do I own this asset? Well, the previous slide says, no, I don't own it. There is no transfer of ownership. So it's not a capital lease. That's one. Then we get to the second criteria. Bargain purchase option. Does the lease have a bargain purchase option? No, it does not. They tell us, right? There's no transfer of ownership during the lease term. There's no bargain purchase option. Nope, it's not a capital lease yet. Perfect. Number 3 says, let me go back. Number 3 says the lease term is equal to greater than 75% of the estimated economic life of the property. Meaning, the problem tells us that it has a economic useful life of 5 years. How many years am I leasing that? 4. So we take the lease term of 4 years, divide that by the economic life, 5 years. We're basically owning this property, or we're using this property for 80% of its useful life, or of its economic life. Yep, it is a capital lease. Stop. Because remember, we have to hit one out of the 4 criteria. Because of the fact that the lease term is equal to or greater than 75% of the economic life of that piece of property, we have to capitalize it. Okay? Now, for sake of argument, let's just keep going. Okay? Because in the real world, we would stop and say it's a capital lease, right? But for sake of argument, let's say that this answer was no. Okay? Well, if that answer is no, let's say we borrow it, or the lease term that we have is, let's say it's 3 years. So 3 divided by 5 gives me 60% of its useful life, right? Is that equal to or greater than 75% of the economic life of the property? No, it's not, right? So we in the real world, we'd have to move to the 4th criteria. The present value of the minimum lease payments are equal to or greater than 90% of the fair market value. Well, if we go back to the explanation, or the details that they give us, it says the present value of the lease payments is equal to, or the present value of the lease payments is $190,000. Okay, cool. That equals the fair market value of the equipment, meaning I could pay $190,000 right now to buy this piece of equipment, or we're comparing that to all the payments that I make over the 4 years. We bring that back to today's dollars. Bringing that back to today's dollars, if that's equal to the fair market value of that piece of equipment, it's a capital lease. So in this case, yes, that criteria is met. It is in fact a capital lease. Okay? Journal entry. Again, since it's a capital lease, we need to debit leased asset equipment. We need to credit lease liability, $190,000. Okay? Now, it's important that the portion of this lease liability that we're gonna pay next year, we actually make that piece of it a current liability. The remainder of that lease obligation that we own is going to be classified as long term. Okay, so and I remember we talked about this in class before. Previously, when we talked about liabilities, we're looking at a liability and we're looking at the total amount that we owe, right? And we know that these payments are going to come due at different points of time throughout the life of that liability. We have to report. We have to take that amount. We need to break it down, and we need to say, okay, how much of this lease payment is due within a year? That's going to be the current piece. The long-term piece is going to be the amount that's due past the year. Okay. Now this is important. Okay. We can amortize, right? When we have bond discounts or bond premiums, we have to amortize that amount. Okay. That whether it's a bond discount or a bond premium. Okay. And basically what we're saying is at the end of the life, the the discount is going to equal 0. And then the carrying value of the bond is going to equal the face amount. We're going to work through an example of this. So I'll show you what that looks like in the demo video. Okay. So that's pretty much it for the lecture portion. When we come back in our next video, we're going to go ahead and work through some demonstration problems, as well as I'm going to do the B problems for your homework. Okay, so tune back in for that one.